Welcome to this week's Market Update, where we review the key developments that shape markets, highlight what drove our recent performance, and look ahead to the important events on the horizon. Let's start with what moved markets this past week, beginning with a continued theme that keeps powering this cycle: artificial intelligence investment. Microsoft reaffirmed its long-term commitment to AI this week, clarifying that recent adjustments to its carbon removal program were short-term calibrations rather than a structural shift. The company plans to honor existing contracts and also announced approximately $18 billion in new AI and cloud infrastructure investment in Australia, underscoring sustained global demand for AI capabilities and disciplined capital allocation toward the highest return opportunities. For our portfolios, this reinforces the case for maintaining exposure to quality growth companies and AI-linked beneficiaries that continue to drive this powerful investment cycle. The financial system also showed its resilience this week as short-term funding markets navigated typical seasonal pressures tied to tax-related cash flows. The Federal Reserve's existing tools remain in place to support smooth market functioning, and core liquidity across the system is healthy. This stable backdrop continues to underpin equity valuations and reinforces our confidence in the broader market structure. Energy markets saw near-term supply tightness lift oil prices this week, but futures markets are pricing meaningful moderation later in the year as supply chains normalize. Strong U.S. production and export capacity continue to provide an important buffer that keeps global energy markets balanced. For our portfolios, this supports a constructive outlook where energy sector strength can coexist with the manageable inflation path and continued economic expansion. Now let's look at what drove our performance over the past week and why we remain confident in our positioning. UnitedHealth Group was our top performer with a strong 11.85% gain, rebounding as investor sentiment around managed care improved and regulatory uncertainty eased. The move reflects a healthy rotation into defensive healthcare exposure as investors look for companies with reliable earnings through uncertain times. UNH's scale, diversified business model, and strong cash flow generation reinforce its role as a core defensive holding in our portfolios. The information technology sector once again led our performance, with solid contributions from Apple, Broadcom, Alphabet, Oracle, Microsoft, and NVIDIA. Stable interest rate expectations and resilient economic data have supported investor willingness to own long-term growth companies, particularly those with strong earnings visibility and AI-driven tailwinds. While valuations remain elevated, the sector's earnings durability and exposure to transformative themes like AI infrastructure and cloud adoption support our continued overweight positioning. Our size strategy was the week's strongest factor contributor, reflecting continued investor preference for large-cap companies with strong balance sheets and earnings visibility. Giants like Apple, Alphabet, Walmart, Caterpillar, and UnitedHealth all contributed, showing the breadth of large-cap leadership across technology, consumer, industrials, and healthcare. This flight to quality dynamic favors the established market leaders we own, whose scale and operational resilience translate into consistent outperformance. Looking ahead, here are the key events we're watching that could shape markets in the coming week. Wednesday brings the Bank of Canada's April rate decision. At its March meeting, the bank held the overnight target rate steady at 2.25% and judged current policy appropriate, though officials acknowledged softer near-term growth after Canadian GDP contracted 0.6% in the fourth quarter, while February's CPI eased to 1.8%. For Canadian portfolios, any shift in tone around the path forward could influence both bond yields and equity positioning, particularly in rate-sensitive sectors. Wednesday also delivers the Federal Reserve's March meeting minutes. The Fed held rates steady at 3.5 to 3.75% for a second consecutive meeting, while still signaling one reduction later this year and another in 2027. Even subtle language shifts can move both stocks and bonds, making this one of the week's most watched releases. Thursday brings core PCE, the Federal Reserve's preferred inflation measure. Recent data showed core PCE rising 0.4% month over month and 3% year over year, down slightly from 3.1%, but still above the Fed's 2% target. Markets watch this closely because it directly informs the Fed's thinking on future rate decisions. Thanks for joining us, and we'll see you next week.